continuing comeback of the volatile technology sector left NASDAQ with a gain for the week. Can't scare our elves, though. Their consensus on the Dow's outlook for the next 3 months remains an ultra-bullish +6. So quickly was the mood improving that one of our bullish chief elves, Michael Metz, grew cautious and changed his vote on the next 6 months to neutral, bringing our elves index down a notch to a still bullish +3. There was no stopping NASDAQ, Amex, or Russell, which seemed to be operating in an entirely different parallel universe, which, come to think of it, may be where good elves come from. Our crew are unchanged at a highly bullish +7.
That, of course, was Louis Rukeyser talking about his iconic elves on the original version of Wall Street Week back in January of 1998. And today we are bringing those elves back, modified and updated a bit. Instead of 10 technical factors crunched by a contributor, which was what Louis had, our elves are real people. They are the 24 equity analysts Bloomberg has relied on for years to come up with a consensus call on where the S&P will end up the year. And as of this week, the median of their projections was 4,025, with Tom Lee of Fundstrat the highest at 4,750, and Michael Kantowitz of Piper Sandler, the most conservative, projecting the S&P 500 will end the year at 3,225. Every week, we're going to check in to see how they are doing and whether they have moved their projections. Still with us are Sharmin Mossavar-Rahmani of Goldman Sachs and David Bianco of DWS Group. So it's great to have you here back. Sharmin, tell me about David Kostin. He's at 4,000 right in the middle.
Yes, he is, and we obviously chat with each other all the time. We go through their earnings views and our earnings views and why are they different and what's driving it. It's interesting because Jan Hatzius, our chief economist at Goldman Sachs, has a 35% probability of a recession. It's one of the lowest in the industry, actually, compared to somebody like Bill Dudley, who's at 60%. So it's very important what is actually being factored into David's numbers. Our view is that the S&P will end up the year at 4,250, so a 13% total return. We allocate a 50% probability to that. And then we have a 20% probability that it actually does much better, and you end up with something like a return in the 20+%. Now, there's a small probability to the downside, but nothing like the lows you have with the new elves. We are more down like 30. There's a 30% probability of 3,600. Our view is that in the background, the backdrop for earnings is generally modestly positive.
David, as I understand it, you were an elf.
Yeah, that's right. I was an elf. Hopefully, I haven't graduated to troll. But yeah, I was one of those equity strategists for many years and would forecast S&P targets. Still do, but what we do now are on the buy side, and those are sell side strategist, research strategist estimates for the S&P. And then you also have bottom-up numbers that come from the individual analyst covering securities. So we all monitor that. That's wonderful stuff. That's something that Wall Street pays a lot of attention to.
So you see a high and a low. What are the factors that are going to determine whether it's high or low, from your point of view, David?
Whether the high turns out to be correct or the lows, I think 4,000 on the S&P at the end of the year, a little bit above 4,000 for the S&P early 2024 is a fair, reasonable outlook. But I think there's downside skewed risks more than usual. I think it's quite possible the S&P revisits 3,600, 3,700 before it moves to something well above 4,200.